Hi, everyone. It's John Pokeroba. It's March 19th, 2022. I wanted to put out a general market update given a lot of activity and changes in the market this past week. So we'll take a look at things. So just a reminder, the presentation is being made by Rain King LLC, and I am an amateur investor, growth investor, not affiliated with IBD or MarketSmith. So the three things we're going to cover in this video today are a brief touch upon the big picture. The context is always important. And then we'll look at the activity during this week. And do we have really a tradable rally, or is this a new bull market? And then we're going to get into some areas of strength currently being shown in the market. So the big picture overview. I still start with the overall super cycle, which is the mega trend. Being led by the millennials entering peak consumption years, where we could be in a situation where that consumption drives a lot of economic activity over the next 15 years. So that's the basic premise. I've talked about it on previous videos in more detail. Long-term trends, the support lines are just trying to make the statement that, you know, this market could come down quite a bit and still be within the big bull supermarket cycle. I use roughly the 11,000 area and still being intact. We've come back down so far back into the 13,000 level. So it all appears, you know, normal so far in that context. Here's a chart of the NASDAQ on a weekly basis as of Friday's close. Probably what's noteworthy about the chart is you'll notice that the NASDAQ put in its biggest weekly volume on the blue volume spike in over a year. So that's noteworthy. Don't know where this is going to go, but you can see we had a kind of an undercut and we closed at the peak, which is a positive sign. So let's get into some of the details about what we see. And is this just a tradable rally, or is this something more or less? Last video 10 days ago, I showed the new lows on the NASDAQ, and I had shown that there were some small improvements, but nothing was really conclusive. And I stated that I wanted to see the new lows dry up to at least less than 275 to help give a clearer picture of where we might be going. So here's an update on that. On the left, these are the new lows in the NASDAQ. And you've noticed we've had a very sharp decline in the new lows. The new lows on the NASDAQ on Friday were only 78, very sharp decline. And that's really a positive development. It's actually the lowest number of new lows in the NASDAQ in over 3 months. So that's encouraging. On the right is the New York Stock Exchange. And paralleling the NASDAQ, there's been a dry up in new lows on the S&P and the New York Stock Exchange. There were only 57 new lows in the New York on Friday. So that's a positive development. We'd like to see that. This is a chart from macro charts. This is the advanced decline line showing key breadth thrusts, very historic breadth thrusts. And they looked at a 4-day thrust. And you see they've drawn this line. When you get this 4-day thrust, it typically has led to some pretty good moves in the market. You see right here in 2009, 2010, another one in 2015-16. This is the COVID one. And then we've just experienced one over the last 4 days, which we'll talk about a little bit more when we talk about the daily NASDAQ. So this is noteworthy and we should be paying attention, but we should also take things in a measured way. So let's look at the daily NASDAQ, which is on the left. And I also threw up a split screen here of the NASDAQ. Back in February, I started to show some possible precedents, and I used the August-September bottom in the NASDAQ as one of those precedents. And some of you have written out to me and said, geez, I don't think that precedent's going to work, and we're really in a bear market, and it's going to be 2018 all over again. So I wanted to revisit that and just see what was happening. So let's just look at the NASDAQ. So we had our initial low. We had our first follow-through day, and the first follow-through day didn't go very far. We had our initial rally high in this range here, and then we came back down and we undercut. And we talked about the undercut 3.9% undercut was not excessive, kind of within the norms of some data that I use. And then we've kind of hovered around. We came all the way back down, and we had this kind of scary undercut of the lows last Monday. And then right off of that, we had the Fed meeting, and things have turned around dramatically, where we've have had 4 pretty strong days up with some decent volume. And we had a day 4 follow through day on the NASDAQ, and we closed right at the 50-day moving average. So looking to the right now, just looking at this potential precedent of the 11 bottom is, we came off the lows in that bottom and created a, initial rally. And you'll notice that we had a very similar situation where we came down and we undercut. We had that scary undercut of the lows, and then we had a sharp rally. And that sharp rally in the 2011 rally actually got above the initial highs. And you'll notice that it went all the way up to the 200-day moving average. At that point, it kind of consolidated and dotted around for a little bit. But the thing that was important is we started to hold at a much higher low. We started to hold things, less of a pullback, which was very, very constructive. But you'll note that there was some consolidation and digestion before the market made another move high. And by the time it reached new highs, it had been 8 months from the peak. This still seems to be a fairly decent scenario to consider. We may do that. We may come up here, get above the 50, run into some resistance potentially at the 200-day or even these old highs from the first rally. That would be constructive to consolidate and then possibly move higher. Or we may completely fall apart and roll over again, but we'll have to see how it plays out. I've been talking about in previous videos about bull market corrections versus bear markets. I'm not going to cover all of this stuff in gray. It's been covered in other videos, but I also showed in those videos the second follow through day. After you've had a failed follow through a day and you undercut the first low, what were the expectations on the second follow through day? I didn't talk about this in great detail in previous videos, but because we weren't there. Now that we've had the second follow through day, I wanted to point out just setting some rough expectations. The second follow through day, generally gains forward could be expected in the range of 9.8% over the next 3 months. And you should never undercut the second follow through day. And if that happens and we consolidate and move higher, could be an average of 90 days to get back to new highs. Now, if this second follow through day were to completely fail, my data shows that we're probably in for a much deeper bear market beyond a 20% deep bear market, which probably is underway, and we were just caught in a rally within a bear market. So at least gives us some expectations to look forward to as the second follow through day develops. So tradable rally or new bull market. As I mentioned, we've had 4 powerful days off the lows, and we've had peak closes. That's all really, really positive action. But probably more important is we're going to learn a whole lot more from the first pullback after this initial rally attempt, this initial thrust that we're seeing. There's a number of things that could happen, and we want to be aware of and know what things we should be looking for on the first pullback. So we want to know if this pullback is going to be sold into further and we roll over very quickly because there's still a lot of institutional selling going on, or are we going to digest this and consolidate the rally thrust and then potentially move higher? So if we were to digest, the things that I would be looking for is I'd be looking for quote change. All of a sudden the market would come back a little bit and it would start to hold key moving averages like the 20-day and the 50-day. The other character change I would look for is the volatility on the pullback should reduce. We've had some very wide trading days the past few months. If we can see smaller price spreads as we digest the gains, that might be a sign that buyers are starting to get in control of the market and prices, which would be a positive development. I would also watch breakouts. Breakouts have not worked well at all for like 3 months. So if we start to see some breakouts, we want to watch them and see if they're going to follow through and stick or if they're going to fail. That's a clue if there's real buying in the market by institutions. And I also want to watch the indexes, and I want to watch the new lows. I don't want the new lows to be expanding at a rapid pace to show that maybe institutions are really still in a selling mode. Now, I noticed on Friday on FinTwit and Twitter, there's a lot of people putting up their portfolios saying, hey, I'm fully invested, I'm on margin, I got all these positions, I'm really, really pushing it. I would really, really caution you about doing that. You do not want to plunge back in the market too aggressively. The market has a way of taking plungers and really teaching them lessons. So I'd be very careful about getting too aggressive too quickly. You can gradually increase your exposure if your initial buys are working. You want to show progress, that you're in the black, you have gains, you have stocks that are working before you increase your exposure. Going to a full exposure too early, if this pullback doesn't work, you're going to be in a lot of trouble. Now, generally, the environment that we're in, higher rates and higher inflationary environment generally does not favor growth stocks. So I think we'll just keep that in the back of our minds, that it's not the best environment for growth stocks. And let's see what happens. I wouldn't be biased to either way, but I would want to just be aware of that. We're not in a great environment for growth. Because as I mentioned, though, the market is looking 6 to 9 months ahead. So it's possible that the Fed can engineer, a soft landing with rate increases that tame inflation, and we don't go into a recession. Maybe then growth would really come back into favor, and risk would be put on by institutions. So maybe the market's looking ahead. This thrust that we're seeing, maybe that's telling us that 6 to 9 months down the road, we could be in a real good place for growth stocks. Just remember that there's plenty of time to get more fully invested if this is the real start of a bull market. We're going to have a pullback, and that pullback is really important to analyze for breadth, for leadership, and the qualities that I just mentioned here. These are the things that we want to see stay constructive in order to put on more exposure. So what are the areas of strength in the market and some ideas? Before we get into some watch list names, I did want to come back to a slide I showed back in early February, which was, we have growth stocks that are at 50%, 60%, 70% off their highs. And there are growth stocks that are only off 20, 30%, 30, 40% off their highs. Very different situations. And you'd really need to understand what you're getting involved with. If you're trying to buy stocks off the low that are 60% off the lows, fallen leaders, this template, you want to see a prior uptrend. And if you get a move off the uptrend, you're going to base. So there could be a longer period of recovery for these fallen leaders. If you find stocks that are on your watch list that are only off 20, 30, 35%, you can see that bases can form more constructively, and you can be at new highs faster with less overhead resistance. So please make sure that you're really evaluating and being selective about which situation you want to get involved with. The Boston meetup on March 10th had we studied bases. We went through proper bases and characteristics that make strong bases, and we went over a whole slew of faulty bases. We covered over 50 stocks, and we did some quizzes along the way with the audience. If you missed that, you should go to the Boston meetup to watch the video. And if you want to see the slides, here's the link that you can get the slides and the link if you want to watch the video. Real timely that we did bases, because we're in a spot now where you should be putting on some exposure, maybe 20 to 30%. I mentioned that these stocks, that the fallen leaders that come off 60, 70%, and I used eBay as an example, these take time to come out of this. We mentioned, eBay had a number of false bases, faulty bases, before it actually tightened up and had a really, really constructive base before making a good move. So this is just more evidence of be careful about buying falling leaders as your first choice. So the areas of strength in the market right now, I don't want to forget, and you shouldn't forget, yet commodities, oil and the metals are in an uptrend. And last week actually provided a very good pullback opportunity to buy some of these oils and metals that are within their uptrends. Devon, Pioneer, Tech, there's just some really good action from pullbacks to either the 20-day moving average or pullbacks down to the 10-week moving average line. So those were good opportunities if you weren't involved in those. We're also seeing the semis start to show some leadership here. The good sign is we're seeing multiple names, not just one stock in the group. There's a bunch of stocks that are starting to really show some strength. Rambus, which had a failed breakout, quickly recovered. Global Foundries, which is an IPO, which is showing potential, and some other semiconductor stocks are acting real well, and their bases are not too deep. Also, if you look at these bases, you'll see that some of the relative strength lines are moving to new high before price. Another very positive characteristic. And on Friday, you'll notice that some of the breakouts in some of these names, so far, they're sticking. And that's very positive because, again, bases have been failing for 3 months. So it's a pretty good indication. If we're seeing some sticking here, that is important to know that they're not being sold at breakouts, are not being sold into, at least not in these semi names so far. Leisure. The leisure group is a very interesting group as the economy reopens. It was showing great relative strength that was apparent before we had the Russian conflict. And with the Ukraine war, all of the leisure stocks basically got slammed back very quickly. They all had failed breakouts, but they're starting to show tennis ball action. Many of them shook out and have reclaimed 50-day moving averages as the weight has come off the general market. Here's a few names that are showing some positive action within the group. It's something that you may want to pay attention and go a little deeper in, as they're trying to set up again. Fallen leaders, I'll just mention it one more time. Long road back after these declines. And I mentioned the eBay example. I know they can be very tempting, but you don't really want to miss out on the new leadership, the new merchandise that might be ready to move really quickly to new highs. That's where some of the best strength is in the market, and you should be looking for new merchandise to lead the new uptrend. A couple stocks that are showing some characteristics that are positive with bases. Bros is interesting because it has had a prior uptrend, and now it's forming a cup base. I believe it's around 35% deep, so it probably needs to handle out before it becomes really actionable. Out has a double bottom. Concentric is a base on base, which is actually a good formation when most of the growth stocks have been really correcting. And Switch is also formed a cup with handle, and it's starting to break out. There's a lot of other names I'm sure all of you have, but those are a few that were noteworthy to me. Hopefully this starts to point you in the right direction. But I think the key is be selective and don't get too aggressive too fast until we see more positive evidence. And the key would be the first pullback to really look at how it reveals itself in terms of the health of the market. Well, that's all the time I have for now, but I really appreciate everybody listening. You can follow me on Twitter. There's my handle, and my YouTube channel. You can see any of the previous videos I've had on the general market. Appreciate it and look forward to seeing and hearing from you all in the next general market update. Thanks a lot.